It wasn't a clerical error, it wasn't a routine rebalancing of a corporate ledger, it wasn't even a standard hedging operation designed to smooth out quarterly earnings. It was the systematic cornering of a strategic asset by the most sophisticated financial plumbing architecture in history. The number is staggering, 750 million ounces. At current valuations, that represents roughly $22 billion of physical metal, but the dollar value is irrelevant. The dollar value is a distraction. What matters is the weight. What matters is the sheer physical gravity of that position. To understand the magnitude of this move, you have to look at the supply chain. Global mining production struggles to meet demand. Industrial consumption in solar panels and electronics is devouring supply. Deficits are becoming structural, and yet in the shadow of these deficits, one entity has allegedly amassed a hoard that rivals the reserves of sovereign nations. The pattern is unmistakable. The arithmetic is merciless. When the dominant player in a paper market quietly becomes the dominant holder of the physical asset, the game has changed. The rules have been rewritten. The pricing mechanism is no longer a discovery tool, it is a camouflage net. Most observers look at the daily price action and see volatility. They see noise, they see the random walk of high-frequency trading algorithms. But if you zoom out, the signal is deafening. The accumulation phase is over, the trap has been set, the paper shorts serve their purpose, now the physical longs are in place. This isn't prophecy, it's positioning under constraints. To understand why a financial titan would execute a maneuver of this scale, we must look at the history of elite positioning during moments of systemic stress. The playbook is not new. It has been refined over a century of crisis panics and monetary resets. The names change, but the incentives remain absolute. Case File 1 takes us to the panic of 1907. Before the Federal Reserve existed, the American banking system was effectively under the command of one man, JPMorgan. The constraint was a liquidity crisis so severe, it threatened to wipe out the New York Stock Exchange and the trust companies that held the nation's savings. The incentive for Morgan was not benevolence, it was survival and consolidation. He understood that in a liquidity vacuum, he who holds the gold and the credit lines becomes the government. Morgan summoned the city's leading bankers to his library on 36th Street. He locked the doors, he literally pocketed the key, he forced them to pool their resources, to bail out the weaker institutions, but only on his terms, and only to save the entities he deemed essential. The result was a massive consolidation of power. Morgan moved first, secured the physical liquidity, and dictated the survival of the system. He didn't just survive the panic, he owned the recovery. Case File 2 moves us to the monetary seizure of 1933. The Great Depression was ravaging the U.S. economy. Deflation was spiraling out of control. The constraint facing the Roosevelt administration was the gold standard, which prevented them from printing enough money to reflate the system. The incentive was to break the link between the dollar and gold, but the wealthy understood the arithmetic long before the public did. In the months leading up to Executive Order 6102, which criminalized the private hoarding of gold, there was a quiet exodus of capital. Insiders who saw the balance of payments crisis recognized that the dollar had to be devalued. They moved their wealth into foreign currencies, or shipped gold to London and Switzerland before the door slammed shut. When the revaluation happened, jumping gold from $20.67 to $35 an ounce, those who had positioned themselves outside the system saw their purchasing power explode. Those who stayed in paper dollars or surrendered their gold saw their wealth transferred to the state. The elite positioned themselves for the reset. The public paid for it. Case File 3 brings us to the precipice of the modern era. 2008, the global financial crisis. The specific event is the collapse of Bear Stearns. The constraint was a toxic balance sheet loaded with subprime mortgages, and crucially a massive concentrated short position in silver. Bear Stearns was effectively shorting a metal that was rising in value, creating a margin call that could not be met. The incentive for the Federal Reserve was to prevent a domino collapse of the derivatives market. Enter JPMorgan. At the behest of the Fed, they acquired Bear Stearns for pennies on the dollar, but they also acquired the headache. That massive silver short position, most analysts expected them to close it out. Instead, current data and regulatory filings suggest they managed it. They used their immense balance sheet to hold the short position, suppressing the paper price of silver for a decade. While simultaneously initiating a massive program to acquire physical bars, they used the paper market to keep the price low, allowing them to buy the physical metal at a discount. It was the ultimate arbitrage. They turned a toxic liability into the greatest accumulation opportunity in modern history. Here is the constraint engine that drives this behavior. Institutional capital operates under the laws of liquidity and duration. When they see a monetary transition approaching, a moment where paper currencies lose credibility, they cannot simply sell everything and buy gold or silver in a single day. The market is too small. If a giant tries to enter a small room, they crush the furniture. If JPMorgan or any major entity tried to buy 750 million ounces of silver on the open market in a week, the price would go vertical, it would break the exchange, it would alert every competitor and retail investor in the world. Therefore, the rational move is suppression. You must cap the price. You must paint the tape with bearish signals. You must use the futures market to create the illusion of ample supply, all while draining the physical vaults in London and New York. The incentive is to maximize the ounces acquired per dollar spent. The risk is that the market realizes the physical metal is gone before the accumulation is complete. This brings us directly to the alleged 750 million ounce position. We are witnessing a profound dislocation between the paper price of silver and the physical reality.